First of all, Comex continues to be drained of silver. Silver is leaving Comex. It's also, I think we're at the lowest level in years. It's also leaving the LBMA. It's about half the level about 4 years ago. And it's also leaving Shanghai, the silver exchange. So where's it going? Well, it's being consumed. And the reason it's being consumed is because the electronics industry is demanding more silver than it's ever demanded ever before. We've had a decade of rising silver demand, much of which is coming from the electronics industry. We've had a decade of falling silver mine production. 4 or 5 years ago, we went into a situation where we passed from surplus to deficit, and the deficit every year now is growing larger and looks like it will continue to grow larger. So the difference between mine supply, which is falling, and industrial consumption, which is rising, that negative gap is getting bigger and likely to continue getting bigger for as far out as the eye can see. So the difference has to be met from above ground stocks of silver. And yes, if you ignore the falling supplies on Comex and LBMA and elsewhere, there's quite a lot of above ground silver, but there's nowhere near as much as there used to be. It's getting less. And as it gets less, you need to offer those who hold that silver an incentive to unload it. And the incentive is a higher price. So everybody has their price. And, the surge in price we saw from, let's say, below $50 to over $100 at one point at the end of January was one of those surges which made an awful lot of people think, that's higher than the price I would have sold at. I'm out of here. So a certain amount of silver came and met the demand. But the evidence is that silver is still which came out, is still being consumed because we're seeing the supplies at the various futures exchanges dropping. So that nothing has really changed relating to the fundamentals of silver. And I think that it's quite possible, and I'd say more likely than not, that silver will continue to see higher prices as the industrial users, who are relatively price insensitive, you can't stop producing cars just because the price of silver's gone from $50 to $150. I mean, it's what is it, $80? But you're not going to say, I'm going to stop the production line while I wait for the silver price to come down. You're not going to do that. So the demand is relatively price insensitive. The supply is relatively insensitive to the price because most of the we've seen a higher silver price, but the mine production has still gone down. So what are we looking at? We're looking at silver, which is being mined as a byproduct mostly of other metals. And the easy mining has mostly gone, which basically means that any increase in supply of silver is going to be from the mines is going to be very marginal, which means that deficit is going to continue growing. In my opinion, and a growing deficit means that you've got to have a higher price to suck out the above ground silver. The supply and demand, as I said, are very inflexible. This is not oil. I mean, if the demand for oil goes up, they could just pump at twice the speed. That's an easy thing. You can't dig the silver up at twice the speed. It doesn't. It doesn't work like that. You can only get out so many tons of silver per day or per week or whatever it is. So what it comes down to is the demand and the supply. Now, I believe that what happened towards the end of January was a lot of consumers of silver, factories and so forth, who are manufacturing solar panels or electronics or whatever else, they became quite nervous and decided to stock up on something a little bit more a bit more silver than just-in-time silver. So a lot of them would have relied on just-in-time supply chains. And then they're seeing and hearing the price of silver's going up, the silver supplies at Comex are going down. What if we can't lay our hands on our traditional supply from our traditional source when the time comes? You know what? Let's buy a bit more just in case. And I think that was one of the things which probably accelerated the move upwards. And now we've had, as a result of that rise, this catastrophic fall for many, where we come down from nearly $130 to $65 at one point. Now we're around 80, I believe. 82 perhaps it is today. You'll know better than I, Elijah, because it's literally been very, very volatile all over the place. You blink and the price is $2 different from when you looked before. And it could be in either direction. So I think perhaps now it's come down. Many of the consumers of silver feel less concerned that Comex I would say Comex, less concerned that their traditional supplies of silver are going to dry up, because obviously some silver must have come out of the woodwork to drive the price down. The other comment I'd make is about the silver shorts. We've always had in the silver market the shorts. These are big bullion banks, and it's quite a legitimate play. Technically they're probably not uncovered because they got silver in place A, and they're doing the shorting on the futures exchange like Comex. It's a nice, easy way to make money over and above your treasury return, because provided you've got the collateral to meet the minimum margin requirement, your collateral can be earning interest whilst at the same time you're selling a 3-month future, waiting for it to get a spot month, and the 3-month future is selling at almost always a higher price than the spot month. That's called the contango. So not only are you making it on your money market or your treasury bill that you've got as collateral, you're also making it by constantly rolling over these futures. And from an economic point of view, you probably feel you don't have any risk because you've got the silver stored in London. And again, that might be earning as well, because perhaps on your behalf, they're lending it out and earning a fee for you as well. So the amount by which these bullion banks can go short is unlimited. But of course, when the price starts rising, then they start to say, oh my God, can we get the silver from place A to place B? And we heard these stories about the smelters being backed up and unable to convert the London-sized bars into the 5,000 ounce bars needed in New York. And suddenly, they although they're financially covered, they got the silver in place A and they need it in place B. Converting to the right, moving from A to B and getting it into the right size bars is not as obvious delay free as they thought. So there was probably a little bit of panic amongst the silver shorts, many of whom were rushing to close their near dated contracts, driving up the price as well.
What they're able to do is that they were able to trade a promise as physical for cash delivery and even allocated gold and silver. And the reason why it worked for so many decades is that there is very little need for physical gold and silver. The major banks, financial institutions, investors, they didn't really feel the need to hold physical gold and silver. The dollar was king. Treasuries were going up in value since, let's say, the early 80s. Up until 2020, yields kept going lower. Treasury values kept going higher. Who needed gold and silver, right? Well, they only used it to speculate. Sometimes there'd be people who want delivery, but they could cope with that, even though the LBMA market was highly leveraged, of course. And in this article today, David Jensen goes over that, but he also goes over the fact that the silver market leverage is increasing distress at major silver exchanges, and they're highly leveraged. What does that mean? Well, they're trading a lot more silver relative to actually how much silver they have in their vaults. And why is this critical now, as he says here in his article? Well, because there's been a silver deficit for years now. I think there's going to be another 300 million added, according to UBS. That's what he says here. And the world, of course, is breaking apart in terms of the globalization is becoming fractured, and paper won't do. There's a rush as well for critical minerals. Hard assets are becoming more and more important. And the bond market, most important of all, treasuries and other government bonds, they've been in a bear market since 2020. And I've shown you many times, if you've been watching me for years, this long-term chart of the 10-year yield, US 10-year yield. You can see that the downward trend, which was very positive for treasuries, the dollar, and keeping gold and silver under control. That trend has been broken, which means yields now are going up, interest rates are going up, and it's a bear market, and bond prices are going down. And that's why central banks, sovereign wealth funds,